How you doing?
It's never better.
Omaha, Nebraska, where the Berkshire Hathaway Annual Meeting is kicking off. We're here sitting down with some of Warren Buffett's best-known shareholders, like GAMCO CEO Mario Gabelli.
Warren has created enormous wealth for 35,000 people who come here today, and all of his shareholders and all the companies that he works with. So we should applaud him.
This is the first annual meeting without one half of the iconic Berkshire duo, board member Sue Decker on continuing Berkshire, without longtime Vice Chair Charlie Munger.
He's left a blueprint that guides us in decision making. So he may be absent, but his impact will go on forever. He's in the DNA of Berkshire.
Plus, checking in with some of Berkshire's most recognizable portfolio companies, like Brooks Running. CEO Dan Sheridan explains where his business is picking up speed.
In China, we're seeing the growth of the middle class, which gives them time for health and wellness. We're seeing races increase over there.
And all aboard, BNSF CEO Katie Farmer operates one of the largest railways in North America, and she's pushing through headwinds for investors.
We're also seeing the structural decline of coal. And so what we need to focus on is really being aggressive relative to our cost structure.
I'm CNBC producer Katie Farmer on the floor of the CHI Health Center in downtown Omaha. Squawk Pod reports Berkshire Hathaway's annual meeting begins right now.
Good morning and welcome to Squawk Box right here on CNBC. We are live at the NASDAQ market site in Times Square. I'm Andrew Ross Sorkin along with Joe Kernan, and Becky Quick is reporting live this morning from the Berkshire Hathaway Annual Meeting in Omaha, which is about to get underway. Becky, good morning, good morning. What do you have coming up?
Hey, good morning, guys. Well, it's just wonderful to see all of you guys. Andrew, in fact, we'll see you a little later here today. But right now, we are at the Berkshire Hathaway Annual Meeting. This is the convention center where things are getting ready. You know, Warren Buffett's going to be holding court here this weekend. They're expecting 40,000 or so shareholders who are going to be gathering here for this annual meeting. And if you look around on the floor here, things look the same. This is the same sort of setup that we've seen for many years here. But obviously, this year is going to be a very different meeting. Of course, this is the first annual meeting since Charlie Munger's death at the end of last year. It's raised a lot of questions about what Berkshire is going to look like after Warren Buffett. And those are the types of things that shareholders have been asking about. Those are the types of things that we've seen reflected in the media, too. Obviously, some big questions that will be thrown towards Warren Buffett, Greg Abel, and Ajit Jain, who are going to be on stage this weekend to answer all of those questions. These are issues that Warren Buffett was pretty direct about in his annual letter to shareholders. He laid out some of the disappointments they've seen in a couple of their major areas. BNSF, the railway, was a disappointment on earnings this time around. Earnings dropped pretty significantly from a year ago, and Buffett laid out how its railroad has fallen behind the other 5 major North American railroads just in terms of margins, operating margins. So I'm sure we'll be hearing a lot about that. He also talked about BHE, Berkshire Hathaway Energy, which obviously is the major utility company that Berkshire Hathaway owns as well, just laid out some of the issues they're seeing on a regulatory front when it comes to the western states. Major fires there, liability issues that have come with it, and in some cases even confiscatory questions that have been raised by regulators. All of those things raising some questions, and we will talk about these issues as we come up. The other major thing is litigation that we've seen for real estate brokers. Berkshire Hathaway did not participate in that litigation that was settled, and so there have been questions that have been raised about that. Gives us a lot of meat to kind of chew over. We do have a big lineup of guests today, including CEOs of some of Berkshire's portfolio companies. By the way, guys, a programming note. Tomorrow we will have full coverage of the annual meeting as Warren Buffett takes the stage to answer shareholder questions. You can tune into CNBC and CNBC.com starting at 9:30 a.m. Eastern for full coverage of everything that's happening here at the meeting. Andrew?
Thanks, Becky. We'll be coming back to you a lot, and then, of course, a lot over the next 24 hours.
Ahead of our weekend coverage of the Berkshire Hathaway Annual Meeting, we're bringing you a series of special interviews right here on the podcast. And first up, Berkshire board member Sue Decker sat down with Becky Quick in Omaha.
The absence of longtime Berkshire Vice Chair Charlie Munger will be felt at this annual meeting here. It's something that the board has been preparing for, with both Warren Buffett and Mr. Munger working well past the age of 90. Joining us right now with what is ahead for Berkshire Hathaway is the company's lead director, Sue Decker. Sue, great to see you.
Great to see you, Becky.
So this is a different meeting, and it does have, I think, shareholders focused on what the future brings for for Berkshire Hathaway. Where are you all in terms of the board on all of this? How are things going, and what do you think about this this year?
Do you mean as it relates to Charlie?
Yeah,
no
Charlie
longer?
not being here.
Yeah, well, first of all, it's sad. He's, a legend, and also I've worked with him closely on the Costco board as well as Berkshire, so it's sad. But I do think that Warren wrote in the annual report a lot about his being an architect of Berkshire, and I think what that means is that he's left a blueprint that guides us in decision making. So he may be absent, but his impact will go on forever. And I think that so his seat will be empty, but I think he's all around us. He's in the air that we breathe. He's in the DNA of Berkshire.
Yeah. What sort of things come to mind when you think about the blueprint that he laid out? What sort of rules or Charlieisms that you kind of keep in mind as a board member?
Well, I think one is just the old ABCs, the absence of arrogance, bureaucracy, and complacency that he tried to instill when he talks about how you should run a business, and the ills that grip a lot of other companies when they don't do that. He's always been, an advocate for frugality, for ethics. Hard to separate those same principles from what Warren's been talking about. The two were very aligned on all that, but I think those principles are really part of Berkshire's identity. So.
Yeah. So there are some issues facing Berkshire Hathaway, and Warren was very clear about it in the letter that he wrote to shareholders this year. Just in terms of disappointments on the earnings, he would point out both Berkshire Hathaway Energy and BNSF. And there are some different problems that are facing each of those sectors, each of those industries, and each of those parts of the company. When it comes to the energy front, how do you kind of look at the liability that's out there? How do you look at the lawsuits that are being brought? And also this confiscatory nature in regulatory creep in some states.
Yeah, I think there's two things to think about when we think about Berkshire Energy. One is just the liability for the wildfires in Oregon, and we've reserved about $2.5 billion. There's not all that on the balance sheet now because we spent some of it, but that's roughly what we estimate the impact will be. Of course, we don't know, but over time, we will become more clear. But I think that's something that Berkshire can easily absorb. I think the bigger question, though, is what does this mean in terms of which Warren wrote about a bit in the annual report, which is that for years and years, the utility business has been guaranteed a rate of return based on a rate base and the regulatory framework.
A partnership with the regulators who say, yes, you should be able to earn a small but decent return.
Exactly.
If you're going to be investing money on the capital expenditures.
Exactly, and so that certain types of capital expenditures can be included in that rate base and others can't. But if you start taking climate change into effect, that either needs to be fully reflected in a rate base or somehow it needs to be borne by society as a whole. It can't really be borne by the electric utility industry. So I think the near-term issues are not so significant for Berkshire. We'll get through it. It's a huge company, $1 trillion balance sheet, so it's going to be manageable. But I think the bigger question is how does that relationship evolve between the government and the utility sector? And I think it's also strategically quite relevant right now because of the world of AI and computational power that is so significant that the draws on the electrical grid are just going to get more and more significant over the next 5 to 10 years with the data centers and supercomputers now. So this needs to get worked out. There has to be otherwise there's going to be a much more risk-averse reaction by the utility industry to invest new capital.
And I guess that could be limiting also in terms of what it means for AI and the power of computing down the road, too. Not to mention the EVs that we are planning to be drawing off the grid, too.
Absolutely.
What type of expenditures would it take to be able to keep up with all of that?
Gosh, I don't know, but I'm just look at Q1 for Meta and Google, Alphabet, and Microsoft. I think the collective CapEx in Q1 was $30 billion for those three companies. That's Q1.
Yeah.
So, and I read recently that some are predicting that data centers, will cost $100 billion in 2030. So, it's a huge amount of capital that is going to be wanting to go into this industry to help fuel this platform shift to AI. And I think it's important that the regulators figure something out here that will incent the right behavior.
Hey, so I've looked through a lot of questions from shareholders, and there are some questions that resurface every year. One of them is the dividend, but that's a question that you hear in more force now, especially as people start to wonder, what is the ability of Berkshire to be able to invest and beat the S&P 500? As the numbers get bigger, it's tougher and tougher. A law of large averages, it's hard to find deals that really move the needle for Berkshire. Do you all talk about a dividend potentially? Because even Warren in the letter this year says, we don't pay a dividend right now, which I think made people question, okay, is he opening the door for one down the road?
Well, I think down the road is a long time and anything could happen. I think so far, clearly, the issue that it's getting harder to generate uses for all the cash is not brand new. So back in, I think it was 2019, we started doing more systematic share repurchases for the first time.
Sure.
There'd been some episodic ones with families and things like that before. But in the last 4 years, if you look at the Treasury stock line and the 10K, you'll see that I think we've repurchased about $75, $80 billion in the last 4 years. So we're starting to pursue that. I think that is a form of cash return to shareholders that is tax efficient. It's also doesn't, it's completely discretionary in any 1 year. So, once you start a dividend, it can be pulled, but the goal is never to stop.
Unless it's a special dividend. That's
well, that's what I say. I almost think in the hierarchy of choices, a special dividend is something in between, something on the Costco board that we've employed really successfully. But that is not something that we're discussing right now. And, over time, things could change, of course. But I think the redeploying the capital through share repurchase is the preferred method at the moment.
Also, questions get raised just about, this is a constant too, but the questions about the power of a conglomerate, if it works. If Berkshire as a conglomerate works and you see the market win and lose favor in terms of conglomerates, whether you're watching GE or any number of them. But people do point back to this idea of, does a conglomerate work, especially if it's not Warren Buffett who's running the whole thing. What's your defense for conglomerates, why the company should stay together?
It is one of the few that has worked, and I guess I point to your point, why has it worked? Well, one is that it's allows for an efficient transfer of capital from businesses that don't need it,
like insurance,
to the regulated businesses that are quite capital intensive in a tax-free way and an extremely efficient way. So that's one source of value. I think another one is the cultural points we were talking about earlier with Charlie. This is a culture that has a collection of businesses that are swimming in with the current behind them because they're making decisions that are long term, they're employing their capital efficiently, et cetera. And I think another reason a conglomerate can make sense, like Berkshire anyway, is the fortress of the balance sheet that gives them flexibility and also allows the company to potentially step in when there are major financial dislocations. I mean, you look at, it's just stunning to me.
The financial crisis.
Yeah. And there will be other situations where the financial markets will get gummed up and there will need to be stability and liquidity. It's stunning to look at looking at the annual report, it's $1 trillion of assets, more than 500 billion of shareholders' equity, larger than the next largest company by almost double. So it's a huge amount of capital all in one place that can move quickly and can help. And that, while it's more episodic in nature, there will be very favorable returns generated from that. So I think for those three reasons, none of those require Warren to be in the seat he's in now. They're all still true, that there's a tax-free transfer of capital, that there's a culture that he and Charlie have built over the years, and the fortress of the balance sheet. I think those are all good reasons to keep Berkshire united as it is today.
Sue Decker, the lead director at Berkshire Hathaway, I want to thank you for your time. And I'm sorry we didn't get to talk about Rafter and other projects companies that you're involved with right now. We'll do that on another time.
Not at all. It's great to see you. Thank you.
Great to see you too, Sue.
Next on Squawk Pod, we're hearing from two of Berkshire's portfolio companies. Brooks Running CEO Dan Sheridan is chasing consumers anywhere he can.
The beauty of running is it's a multi-channel strategy. We know that if we can influence them through our e-commerce channel, that they're going to find our brand in other channels and purchase us.
And Katie Farmer, CEO of BNSF, one of North America's largest railway operators, is navigating shrinking margins and an evolving industry.
We need to get everything we can out of our assets, and we need to get value for what it is that we do. Our business very closely tracks the industrial and consumer economies, and so we need to evolve and we need to adjust, and we know we need to do more relative to cost.
Much more from Omaha right after this. Welcome back to Squawk Pod, where Joe Kernan and Andrew Ross Sorkin are hosting from our studio at the NASDAQ in Times Square. And Becky Quick is in Omaha with the growing crowds of Berkshire Hathaway shareholders convening here in Nebraska for the annual meeting that kicks off this weekend. It is a huge festival-level event every year, and part of the fun is the convention center floor, filled with interactive booths and shops from Berkshire portfolio companies, like this next one, Brooks Running. Here's Becky.
Brooks Running is one of several billion-dollar-plus brands within the Berkshire portfolio. The company claiming the #1 spot in adult performance running footwear in the U.S. for 2 years running. A little pun there. And growing its international footprint at the same time. Our next guest has been with the Seattle-based footwear company for his entire career. That's a quarter of a century. But he just assumed the CEO job a week ago. Joining us right now is Brooks Running CEO Dan Sheridan. And Dan, welcome. Great to see you.
Hi, Becky. Thanks for having me.
So there's a lot happening in Brooks Running. First of all, congratulations on the new position.
Thank you.
Been there 25 years. I'm assuming you're up and ready to go with everything that's happening. What's the biggest step about coming into this new role?
Yeah, I think it's a few things. One, I've been with the company my entire career, so I tell people I grew up there. But we've just got great growth opportunities coming. You know, the biggest is globally. We're about 85% North America right now. So our opportunity is to spread this brand in our global markets, which we're very excited about.
Yeah, you just came out with your own numbers that you released on the quarter, record revenue, and I was shocked to see the growth in China. I didn't even realize you were selling there.
Yeah, we launched in China a couple of years ago, and it's been slow growth for us at first. You know, that market is very different than many of the markets we compete in today. But we're going to launch some stores in China. It'll be our first kind of entry into brick and mortar. And so we're seeing really nice growth. We grew 180% in the first quarter of this year. And so, you know, it's a huge market. And runners are resonating with our products and our programs over there.
I'm actually surprised to hear it. We hear stories about how the Chinese consumer doesn't really want American goods right now. You hear about the pushback on American brands like an Apple or a Nike. What makes you think that they're ready for Brooks?
Well, I think, you know, first and foremost, the market is really strong. Runners are participating at a rate that we haven't seen in many, many years around the world. But in China, we're seeing the growth of the middle class, which gives them time for health and wellness. We're seeing races increase over there. And so when we see those kind of trends, we know immediately that our brand will be right in the middle of that. Great products, great programs for them.
What's happening in the United States? Because there was this huge surge in health and wellness during the COVID years. Again, you're another one of those brands that you saw a huge uptake as more people started running because they had more time on their hands. Has that continued? Has it not? Yeah,
participation rates were sticky after COVID. You know, more people running and walking than ever. We saw that. But now we've seen races come back in all of our markets. Race registration is up 10% year over year. Yeah, it's incredible.
In the United States?
In the United States. And that drove our growth in the first quarter. We grew 13% in the U.S. in the first quarter. And our e-commerce business grew over 20%, which is just an indication of all the demand that's out there for our brand and our products.
Did your sales in the stores drop? Are these sales that used to be going to the stores that are now going to online?
No, we're seeing actually double-digit growth in our wholesale channel with all of our retailers as well. So the beauty of running is it's a multi-channel strategy. And so what we try and do is we try and be where runners research, where they try brands, and ultimately where they're going to purchase them. And we don't really favor a channel. We know that if we can influence them through our e-commerce channel, that they're going to find our brand in other channels and purchase us. So it's been a great strategy for us.
Are your margins higher in your e-commerce business, or is the shipping kind of cut back on what you would have made by not having a store?
It's about the same. Yeah. Very, very minimal difference between the channels.
So what's your biggest issue right now?
Well, that's a hard question. I mean, there's a lot. You know, with growth comes challenges in execution. You know, one of the things we did during COVID when it was really hard is we invested in systems, we invested in our distribution network. So we're set up for growth here, and our biggest challenge will be international growth. Different markets, different cultures, different ways to go to market with the runner, and so that'll be our biggest challenge, but it's also our biggest opportunity.
How are you finding the employment market right now? How is it finding employees?
Yeah, I would tell you that it's stabilized for us. We've settled into a nice spot. There's always roles throughout your organization that are harder to recruit in, like design, creative, things like that. But overall, the labor market's really steady for us.
And Dan, we're here at the Berkshire Hathaway Annual Meeting. It's the first meeting without Charlie, and that's obviously a big difference. You've been working with Greg Abel, the vice chairman, who is in charge of all the non-insurance operations at Berkshire Hathaway for several years now. Greg's obviously the heir apparent as the CEO here too. What would you say about that relationship and how things work with Greg Abel?
Yeah, it's been incredible. I've been able to engage with Greg over many years now. And, you know, Greg is one of the most attentive managers I've ever been a part of.
Attentive is not always a good word when people are describing their managers.
No, it's great, you know, and the way I explain it is that at any moment you can pick up the phone and call Greg. And he's such a wise man in terms of the guidance that he gives us. You know, I think over the last couple of years, one of the things he's always said is focus on your customer, and that's served us really well.
That's great. Dan, I want to thank you very much for being with us. And again, congratulations. Oh, these are the new shoes, by the way.
These are the
Every
new
year
shoes.
You guys bring out shoes for Berkshire Hathaway. These are special to the meeting. They say BRK on them. How many of these do you think you'll sell?
We'll sell close to 1,000 pairs here at the expo here. This is the Adrenaline 22, and it's our franchise style, which many runners have around the world.
What's Adrenaline? What's special about this one?
This is inherent stability. So what we know is that every runner or walker needs stability, and so we build stability into these shoes, and it's a very inclusive fit as well, so many people can fit into it.
You give shareholders a discount, or they cost more because they're special edition?
We keep the MSRP the same, but these are special edition. You can imagine the demand for this.
Yeah. Dan, thank you. Looking forward to everything here this weekend, and we appreciate sitting down with you.
Thanks, Becky. Thanks for having me.
Joe, we'll send it back over to you.
Becky, is this like a shoe store? What size are those? Because you know how shoe stores, you go, oh, I like that shoe, and you look at it, it's like an 8. Do they have Sorkin size shoes?
This is a 10. The men's version is a size 10.
10 is kind of on the small side, but do they do that on purpose so they don't look like big clunky shoes?
So they don't look like big clunky
like in shoe stores. The ones that they have out are never
Dan?
13s. Yeah.
Joe, we can fit you for whatever size.
I'm worried about. I'm fine.
That's
I'm
the
worried
best
about
part.
Sorkin. What are you like?
Oh, okay.
Yeah.
Yeah.
Oh,
Andrew,
that's it.
Andrew, we can help you out.
Okay.
What are you, Joe?
What's going to be this is going to be like a big drop, as they say in the business. Is it going to be like resale value on StockX on Monday?
Absolutely. These are special editions. So if you don't get them here, it's going to be really hard to get.
Maybe I do want to. So I'm only a half. I'm only a half less than you.
You know those Travis Scotts, the Nikes. They just dropped this week.
Yeah.
They're worth like 3 times what they were selling MSRP. These might maybe have a chance.
Sometimes I have no idea what you're talking about.
You know what I'm talking about. He knows what I'm talking about, though.
Warren Buffett and his team at Berkshire Hathaway have built a family of over 40 subsidiaries, including Brooks Running. GEICO is also among them, Dairy Queen, Fruit of the Loom, and this next one of the largest railroad operators in North America. Let's get back to Becky.
Our next guest runs Berkshire subsidiary BNSF. It is the largest of 6 major rail systems across North America. BNSF CEO Katie Farmer joins us right now. And Katie, good morning.
Good morning, Becky.
Let's talk the economy broadly, because rail car loadings are a great indicator of what's happening in the economy. What are you seeing right now?
You know, Becky, it's really a mixed bag. We divide our business into 3 segments. Our consumer product segment, which is really international, intermodal, domestic intermodal, and automotive. The consumer's really hanging in there. We saw a drawdown in inventory following the pandemic, and that impacted our loadings last year. This year, the loadings have picked up and rebuilt that inventory, and so international intermodal has been fairly strong for us. Domestic intermodal a little bit more challenged because of the excess truck capacity that exists in the market. Okay. And then automotive inventory rebuild as well. If you turn to our industrial segment, that's a mixed bag as well. It's, chemicals and plastics, things like that are up significantly. Anything related to home building, lumber is down, challenged because of the higher interest rates. And that's also the segment that we put coal in as well. And coal obviously was in structural decline, but with the low natural gas prices, as well as the really oversupply of natural gas in the market, those volumes have been challenged for us. And then finally, in our agricultural products segment, we had a really strong first quarter relative to volumes. We saw about 60% more grain that we loaded to the Pacific Northwest. We also see an emerging market there in renewable diesel, which is a great market for us because we get to handle the raw products inbound and then the finished products outbound. So it's really a mixed segments, really.
Warren Buffett wrote in the annual shareholders letter about how operating profit was down, and that was a disappointment. What happened?
Well, 2023 was definitely a challenging year, and our performance reflects those challenges. We know that we need to, for our customers, we need to be we need to work on our cost structure. And our business...
Meaning lower prices?
No, what it means is that we need to be efficient and productive. We know that we need to offer industry-leading service. We need to get everything we can out of our assets, and we need to get value for what it is that we do. Our business very closely tracks the industrial and consumer economies, and so we need to evolve and we need to adjust, and we know we need to do more relative to costs.
How do you do that? Because Warren also pointed out that your profit margins relative to the 5 major other North American railroads have fallen since Berkshire Hathaway bought the company back in 2010. So over the last 14 years, what specifically can you do to change that?
Well, our business is really in a transitional period. We're seeing our portfolio move to be much greater percentage of that portfolio in intermodal. And as you know, there's a lot of truck capacity right now, so there's some headwinds with that. We're also seeing the structural decline of coal. And so what we need to focus on is really being aggressive relative to our cost structure, making sure that we're giving our customers a competitive cost structure and good industry-leading service so that they can be competitive in their markets. I would say also, Becky, that during 2023, we worked to extend contracts with our customers, brought new volume onto the railroad, and we start the first quarter of 2024 with increased volumes and a record market share in intermodal.
Okay. It is a capital-intensive business. I think you're planning to spend something like $4 billion. What's that going to go toward?
A large percentage of that $4 billion capital goes to maintaining our infrastructure. As you know, we maintain our own infrastructure, and we have to do that because we have to give customers a reliable service product. We have to maintain an infrastructure that's safe for our customers, but we're also investing in expansion as well. One of the projects that we're excited about is the Barstow International Gateway in California. We affectionately refer to it as BIG, and it's going to be an intermodal hub with adjacent land where our customers can co-locate adjacent to that hub. Back during the supply chain challenges, you saw a lot of the vessels that were queuing up at the ports of LA and Long Beach. This is an opportunity for us to improve the efficiency and the productivity of the supply chain through the ports of LA and Long Beach by taking that freight, moving it through the Alameda corridor into that new facility in Barstow, which really gives us the opportunity to offer customers, a sustainable solution, a really competitive option where we can offer new services to the interior of the country.
California is not always an easy place to do business, though. There is some regulatory. The California Air Resources Board finalized what they are calling their in-use locomotive regulation. It's calling for zero-emission locomotives by the year 2030. Is that even possible? Trains run on diesel.
Yeah, it's a real challenge for us right now because there's no viable technology right now, and certainly within the time frame that the California Air Resource Board is proposing, there will not be zero or near zero emissions locomotives. The challenge with this regulation is that if CARB is granted the waiver by the EPA, we believe, Becky, that the fund that we would have to pay into would cost BNSF about $800 million a year. So not only is the technology not there, but the cost that the American consumer would bear because of this would be really devastating to the economy.
I mean, would that make it even less competitive with trucking?
And that's the really unfortunate part about all of this is that rail handles 40% of the long haul in this country, and we really only account for about 0.5% of the greenhouse gas. So the unintended consequence of this is there'd probably be more traffic moving by truck over the road. And so we have grave concerns with this, and the concern is that if the EPA allows us to go forward, my concern is that there'll be 17 or 18 more states that will adopt this, which would significantly impact the American consumer.
I mean, does that make it almost impossible for you to do business competitively at that point?
Well, I have to tell you that if this does go into effect, we would seriously have to look at our investment in our Barstow International Gateway project.
Okay. Katie Farmer, BNSF, really want to thank you for being with us today.
Thank you. Appreciate it, Becky.
Coming up next on Squawk Pod, one of Berkshire's better-known shareholders, Mario Gabelli, the future of Berkshire Hathaway, and the legacy of Charlie Munger.
I want you to have your own personal peanut brittle so that you can think of Charlie when you're on the stage.
Welcome back to our Berkshire Hathaway Annual Meeting coverage here on Squawk Pod. Most Berkshire Hathaway shareholders are long-standing fans of Chairman and CEO Warren Buffett and longtime Vice Chair Charlie Munger. They've been betting with Berkshire for years, and this next guest is no exception. In fact, many of you, our listeners, might have been betting with him for years. It's legendary investor Mario Gabelli. Let's get back to Becky again in Omaha.
Joining us right now is longtime Berkshire shareholder, Class A shareholder, I should add, Mario Gabelli, who is the CEO of GAMCO Investors and who's been coming here for decades to this meeting, but who has known Warren Buffett since all the way back to the 1960s. Mario, this is a very different meeting because it's the first one without Charlie. What are you looking for in this meeting? What do you think?
Well, first of all, because of that, I want you to have your own personal peanut brittle so that you can think of Charlie when you're on the stage this morning. Look, go back to the 60s when Warren left the hedge fund business and bought a business. The idea at that time was to buy businesses that you could buy for less than liquidation value, kind of cigar butt investing. And as time evolved, he did other things, and then he gives full credit in his annual report to how Charlie said good businesses, good management, and reasonable price. And then the question is, what do we do next? What is Warren going to do because of all of his liquidity and the world that he's in terms of the style of what he buys? So he's buying pieces of companies, much like we do in our portfolios. We have lots of little businesses that we think are okay, and some don't do well. We have our own equivalent. So that's the question. The second part is that the world changes. You know, he's probably had more litigation dynamics in the last 90 year than he's had in a long period of time prior to that. So he'll adopt and he'll do great. For example, last year he had $15 billion of his holdings in Japan. He now has $25 billion, even with the yen at 155. Last year the yen was 133. So what is he thinking about on a global basis? So that's it.
Okay, so some of those questions, let's jump into that. The litigation factor, Berkshire Hathaway Energy has been front and center for much of that. And Warren wrote about that in the annual letter, just the problems on a regulatory front. So what do you see as the potential solutions for a problem like that?
There are going to always be issues. I happen to think more generic. In England, losing party pays. So therefore,
if you sue somebody and you lose.
And that would make a little bit more difference in terms of the focus and the attention.
Because you think that these are not valid lawsuits that are being brought?
No, not with regards to Warren, but you're talking more at a broader scope. From Warren's point of view, the notion of starting what goes on in the change in the climate and the impact on energy, the wildfire in West Texas recently, I forgot the name, what impact does that have? Assuming you had nothing to do with it, you're still going to get probed. Assuming you have something, the challenges of having transmission. I'm a data center. I need electricity. I'm an EV. I need electricity. Where's electricity? Renewable. I want quality. I want small nuclear reactors a long way off. I want to have distribution.
And by the way, I want it really cheap.
Yeah, well, you don't want the consumer to pay.
Right.
So one of the things that I've been thinking about is I had a bank in the 1930s. You had the movie. And the banks go bust, but you had FDIC insurance funded by the other banks, just like you saw the, Republic First and First Republic. I forget which one was first. And so why not have those that own data centers, like Apple, put money into an insurance fund that if they're taking energy from an area where there's a wildfire or some kind of fire, they help fund it like the FDIC. So there are a lot of things going on. So that's Warren. He's appropriate. If I get tarred and feathered and I don't get a return on investment, I have to think what's morally right and what's legally right and what's financially right. So that's what he's going through.
And as a shareholder, you feel confident in all of this, though? Or what are you thinking as a long-term Berkshire shareholder?
Well, I would not have thought about the impact of what Pacific Gas and Electric went through because of the wildfires. the notion of having different climate at different points. I always thought about, you're going to have a hurricane, you're going to have a tornado, you're going to have an earthquake. But the notion of consistent damage to the environment, maybe that your transmission is going through that, it's very hard to put it all on the ground. How else do we find distributed power? So I have it at my data center, my EV, without going through the system. That's a de minimis dynamic. And look at Warren Buffett, his book value, that is GAAP, generally accepted principles, book value, is the largest of any company. And he's growing that. And he's got, if he sits back and does nothing and yawns, he's making 5% T-bills. Yesterday, doing nothing after the market closed, I think he made $8 billion on the tick up of 10 points in Apple. So sit back and say, what businesses do I want to own? Where are they? How do we have the capitalism that allowed him to succeed? How do we keep that in place given the dynamics of the world and the dynamics of the United States? And then when a LeBron James makes a lot of money, or Taylor Swift makes a lot of money, we applaud that. Ohtani playing for the LA Dodgers against the Atlanta Braves tonight, if they make a lot of money. If individuals create businesses, they should be applauded. And so Warren has created enormous wealth for 35,000 people who come here today, and all of his shareholders and all the companies that he works with. So we should applaud him. So that's it.
There are going to be questions about some of the holdings, including Paramount, biggest shareholder, I believe, in Paramount, in Berkshire. You're a pretty big shareholder in Paramount, too. What do you think about the deals that are circulating right now? We just heard about another potential offer that could be in the works. What do you think of the existing offer on the table? What do you think of the new ones?
As an analyst, I gathered the data, read the data, project, interpret, communicate. I started following Viacom when it was spun off from CBS, blah, blah, blah. I knew Sumner because of the theater business. Fast forward, there's 40 million shares of voting stock. They closed at 26, call it 25 yesterday. $10 billion. So we own 5 million for my about 900 clients. What I'm concerned about and thinking about
is... It was at 13 yesterday, right?
What?
Or you're talking
I'm talking about the voting stock.
Yeah, okay, the voting stock.
Yeah, like Warren Buffett buys Lennar Voting.
Mm-hmm.
You buy the voting. Lennar Voting was a 10-point discount. When I started buying the voting stock, I had to convince Sumner to allow me to exchange my voting stock for lower voting because the lower voting was selling higher because it was PA or whatever. Bottom line, what do we need? We need content. Going back to the days of the Gladiator, going back to the days of silent television, silent movies. So content, and they have the scale. What they need is someone that can look at 100 scripts and figure out which of those may have a higher success rate. And so bringing in an organization like Skydance makes sense. The second part is the problem is a great opportunity, great tailwind.
But you don't own the voting stock in Paramount. You own the general.
No, I own 1 million shares of the general, of the one you saw. It was 13 and change.
Yeah.
I own 5 million of the 10 million that are not held by the public.
So you're in the camp with Sherry Redstone, and that's the question. Is
no, I'm in the camp of fighting for every shareholder to get the same price as Sherry Redstone because the problem is at National Amusements.
Okay.
She has some leverage. Look, she didn't anticipate the challenges with COVID at the movie theaters. Last year when they cut the dividend, what happened afterwards, you had the Screen Actors strike, you had the Writers Guild strike, and so box office was choppy. So you have theaters and you have leverage. You just read the Marcus annual report. You read the annual report of the other theater companies. You see the challenges she's facing.
So is Skydance fair for all shareholders or not?
I don't know the deal. I am Yogi Berra. I'm waiting, and until, I say to myself, this is the problem of being a Yankee fan. It ain't over till it's over. So now if you have a free market system, the deal that was on the table that you're referring to is from Apollo with Sony. Sony and Paramount were going to do a deal in distribution globally. They bring not, to me, the intensity on the content that Skydance does, but they bring a lot. Both of those.
They bring more money, $26 billion.
Well, $26 billion is, not bad. Bottom line, you basically have the following. Neither those entities can want to own the TV station. You don't want FCC regulation. It's just challenging. So you got to spin off that. That theater television business, linear television, which has got some question marks long term, they're going to have a tsunami this year because of all the elections. You're going to earn $700 to $800 million at CBS TV stations worth 5 or 6 times. I can spin that off. I'll talk to more about corporate lovemaking, financial engineering. But in this particular case, if I got $26 billion, I knock off $12 billion, the press gets it. Get the $12 billion right, okay? It's not a higher number. The second part is I divide that. Sherry deserves a premium for voting control. The question is how much?
Okay.
But there's only 40 million of that. If they pay her 30, that's 1.2 billion. So I go from 26 minus, you do the math, you come up with a $20 plus for the 650 million of the non-voting stock. And so then the question is, if I'm buying it, I want to make money.
Right.
One will take it private or come up with different creations. They got to spin off. Sony can't own a TV station, neither can Skydance or want it.
Mario, they're screaming in my ear, we have to go.
I agree with that.
You are a famous Columbia University graduate. Warren from these days. What do you think of the situation on campus?
Listen, I was president of my student body at another university, but I went to graduate school there. I like creative tension. I like the fact that people like Joe and Andrew can argue on television and still be friends. That's what the campus should be all about. And protect the students. So to the degree that you have a campus where somebody's coming in that are not students, that are trying to interrupt, they're trying to occupy something and disrupting the students that are there, I just do it. And credit to the New York Police Department for the restraint. About 5 months ago, Becky, I was in Kent State
yeah,
in Ohio, in part because there was the dedication to the Crawford Business School there, Ambassador Crawford. And I walked up the hill.
Yeah, where 4 students were
And
shot.
4 students died, and it just saddens me when I hear stories about that they are creating that kind of challenge. Protect everyone.
Mario, thank you. We really appreciate your time today, and it's great
Glad to be here.
Thank you for listening to this special Squawk Pod Reports from Omaha, Nebraska. Stay tuned to your podcast feed. We'll be publishing bonus content this weekend as 40,000 shareholders come to the Midwest for the Berkshire Hathaway Annual Meeting. We'll have all the highlights of Warren Buffett's Q&A and some extras just for podcast listeners. Squawk Box is hosted by Joe Kernan, Becky Quick, and Andrew Ross Sorkin. Squawk Pod is produced by me, Katie Kramer, Cameron Costa, Zach Valisi, and Caroline Rahotis. This episode was edited by Avelio Rodriguez. Have a great day.